Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Dear viewers, hello and welcome to today's video. In this video, I am going to cover an industry that is witnessing strong tailwinds of digitization and tech adaptation and is one of the fastest growing segments in India. I am speaking about SaaS or software as a service. In this video, I am going to share a simple rule of thumb to assess the performance of SaaS and tech companies that use this model. And using that, we will see which 6 companies score well on this. But before I come to that, let us understand what SaaS is. SaaS or software as a service is a model where the users pay for software on a subscription basis as against buying it one time. You see, in a conventional software delivery model, the software is installed or downloaded on a particular machine or set of machines. On the contrary, under SaaS model, the client does not need to install and run app on a limited set of computers or localized hardware. One can access software or service from any device with internet connection and browser. The app itself is located on a remote cloud network and can be accessed through the web or an app. So what does it imply for its users or clients? Well, under SaaS model, the user does not have to pay a huge upfront fee to buy the software because he can rent it now and pay as per use. That is, like in case of a subscription model. The client also saves cost on hardware acquisition, installation, upgradation, and support. As such, the cost of ownership gets distributed over time based on use and is more affordable and easy on the cash flows of user. This makes it popular among small businesses with lower budgets. Now let us see how SaaS is different from traditional model for software companies. The first aspect is scalability. Lower upfront cost for client allows more customer acquisition in less time and with lesser resources. Do note that the upfront revenue for software companies from a single customer is lower than the traditional model. However, SaaS model allows companies to increase the lifetime value of the users due to lesser customer churn, better tracking of the clients, and ability to upsell over time. So this model incentivizes software provider to update and develop further the product or the service offered because revenues come over time as against a single big time payment. The software works through cloud delivery model. The cloud provider could be a third party. It is less susceptible to plagiarism or copyright violation. Over time, an efficient SaaS model or transition results in lower marketing spend as a percentage of sales, higher revenue per user over time due to increase in customer lifetime value, and recurring and hence more predictable revenue stream for the companies due to subscription model rather than one-time sale. In short, it's a win-win model for customers and software vendors. Example of SaaS are MS Office 365 products, Salesforce, and Adobe is one business that has made a significant and successful transition from traditional to SaaS model. Now SaaS has become a disruptive force to conventional way of delivering software, and a lot of tech and software companies are integrating this in their businesses. So with this introduction, let me now come to a golden rule which is used to assess the performance of SaaS companies. This rule of thumb is called Rule of 40. What it says is, a SaaS company is considered to be in a good place if its revenue growth plus EBITDA margin or operating profit margin is 40% or above. It allows for some trade-off between sales growth and profits. Remember, SaaS model allows companies to upsell and increase lifetime values of customers, so it's okay to go easy on EBITDA margins if it allows scalability and gain in market share. Come to think of it, this is what most new age businesses that are getting listed are doing. I consider SaaS better since the trade-off between the growth and profits is not absolute. SaaS companies are scaling up with growing profits, unlike in case of most new age businesses that make losses like Zomato and Paytm. Now I've applied this rule of 40 to companies in the software, tech, and platform companies, and here is the outcome. I further narrowed down this selection to the companies that have A. shown double-digit growth rates in FY21 because growth remains our primary focus, B. positive margins, C. a minimum revenue of Rs 1 billion, 4. minimum market cap of Rs 3 billion. Lastly, I have chosen companies that have qualified on the Rule of 40 metric for at least 3 of the last 5 years, that is from FY17 to FY21. I have done this to allow companies that have entered this space relatively recently and considering the impact of pandemic in FY20 and FY21. With these filters, the companies that make it to the list include Tanla Platform, FL India, Infosys, Tata Elxsi, Intellect Design Arena, and Mastech Limited. Please note that this does not imply a buy view on any of the above stocks. This is simply a rule of thumb and one of the key parameters to assess the relative performance of the companies in this space. If you find this video useful, please like and share your comments. And for more such information, please subscribe to Equitymaster YouTube channel. Thank you for watching. Goodbye.